Hey guys, David Robinson here. Welcome to the Lead Sponsor Podcast. We've got another great episode for you today. My guest is a former hedge fund manager turned real estate investor who, in the 2008 recession, sold all of his real estate holdings, excluding his primary residence, in late 2007 because he foresaw what was coming in the recession, and then started buying again in 2011, 2012, and really timed the market very well, understands the market at a very deep level, really focuses on his research into the markets and macroeconomics, and really excited to have Bruce Fraser with Elkhorn Capital with us on the show today. We dive into his background as a hedge fund manager and also his transition into real estate investing and why he focuses in the multifamily space. We also talk about the markets that he's invested in, the research that he's done, the key metrics that he tracks to determine a market that he wants to be in. And we talk about the economy, what's happening in the market today with the challenges as far as inflation are concerned, interest rate hikes, and how he and his team are navigating that moving forward, and what we might expect in the coming months and year ahead. And I really enjoyed my conversation with Bruce today, and hope you will too. So without further ado, Mr. Bruce Fraser. Mr. Bruce Fraser, welcome to the show. Appreciate you coming on.
Hey, thanks, David. I appreciate it. Thanks for having me.
Yeah, my pleasure. So I gave our listeners a little bit of an introduction to you and a little bit about your background. But before we dive into things, I'd like to just sort of hear your story. If you can, back up, tell us a little bit about your background, your transition into real estate investing, and what your business looks like today at a high level.
Okay, sure. Yeah. I think my background's a little bit different than a lot of people that you find in the multifamily industry. You see a lot of people that flipped a house or two and then kind of just grew into smaller multifamily and then larger multifamily if they're successful. For me, it's really quite different. Mine is a strategic investment allocation decision because I formerly ran actually two different hedge funds for a long time, very successfully. In fact, our equity strategy was, I think we've delivered like 580%, 580 plus percent over a period when the S&P lost 2%. And so, we also sidestepped the financial crisis in the public markets. And I think we were -2 in '08, and we were at our all-time highs again by the troughs of '09. And so we really, a lot of people say, gosh, you're so lucky, but it's really just really deep quantitative analysis of what's going on in the world, looking at the data and not just the headlines. We don't get all of our news from Twitter quips, and so we actually do the deep dive and try to figure out what is going on, just not what's the political narrative of the time. So because of that, you look at the financial crisis, and to us it was clear and apparent that the Fed was going to start printing money, debasing the currency and devaluing its purchasing power over time. And so we really wanted to focus on hard assets. I had already been doing some real estate investing, and because of the research I was doing in the hedge fund, we literally sold all of our income property or investment property in late '07. And so we took all of our chips off the table and didn't start reinvesting again until I think it was 2010, late 2010, 2011. Initially, banks weren't lending. Banks were still bleeding profusely from the losses they had taken in the great financial crisis. And so everything we did had to be cash. And so we were starting off doing some smaller deals, fix and flips like a lot of people, but we were doing hard money lending. We were doing some buying some bank assets and selling those, different things like that. But everything went really well over those couple of years, and we started sending money back to partners, and nobody was worried anymore. So everybody said, let's just go buy some stuff, longer term outlook. Banks were lending again. And so we moved, we directed our investment capital into multifamily. We feel like that's the best risk reward investment vehicle in the hard asset category. So that's why we do what we do.
Love it. And what does your business look like today at a high level, structure wise, personnel wise, and focus?
Um, well, because of our scale, we have a couple thousand doors that we directly control. We don't co-GP anything, or we haven't to date. So those are all our doors. We have kind of changed over time, but we initially, being a former stock market guy, you look at it and you think, gosh, I need to diversify. I need to be in all these different markets. Maybe have an asset here, have an asset there, and really quickly found out that that was not the best way to go. You just pull too thin. You're traveling all over the place if you're doing what you need to do as far as checking on your properties and making sure operations are running smoothly. And so instead, we really have a model now where any market that we enter, we really want to grow it to 1,500 to 2,000 doors in each market that we're in. And so when we look at a market, even if we see an attractive deal that we want to see if we can find two or three more, because owning 100 or 200 units in a whole new market is really inefficient for us. And so we would rather be able to quickly get to at least 500 or 1,000 doors right off the bat, at least where we have some initial scale, and then continue to grow it from there. And we find that that's really a benefit not only with our broker relationships. In the markets we're in, a broker could call me and not introduce himself, and I'm going to know his voice and know who he is, because we have that kind of relationship with them, and they know us. They've seen what we can do. They know we're well capitalized, and we do what we say what we say. There's no surprise. Just like any other type of salesperson, if they go under contract or something, they're already spending that money mentally. Their wife's already
Mm-hmm.
picking out the new Escalade, and things like that. And so when things don't close, they home front's not happy for the brokers, and so whether it's a wife or a husband that's not happy. And so um, anyway, we always take care of them. We feel like brokers are invaluable resources to us, and we'd rather do a dozen deals with them than try to skim 50 grand out of their commission or something like that. And so, um, but it's not just the broker relationships; it's also vendor relationships, and so. Both contractors, any kind of subcontractors that we use, because of the scale and the volume of work that we typically do, we really made some people's businesses for them. And so when that happens, an ice storm comes through town and everybody has trouble getting it cleaned out. We don't even have to make a call. The guy's already on the property.
Mm-hmm.
Even though that's not his job, it's just that we had a general contractor in a huge ice storm in one of our markets, and he literally was there at 8 a.m. trying to clean out so that they could get in the office and everything else. And we had him to call him. And so stuff like that is just really valuable versus
And
just being another guy on the list that they'll get to eventually.
yeah, and so that hyper focus from a geographic perspective, what markets are you currently in today, and what have you focused on?
Yeah, I don't, I'll tell you where we are heavily right now, and we focus on the South and Midwest. It's not a political statement at all, but we focus on red states just because of ease of doing business and the ability. We're landlords, and the product that we have are units to rent. And if we have people that are living in them and we can't evict them when they don't pay us, that's not a very good business. And so we really avoid areas that have very difficult landlord laws. And so that keep focuses on the South and Midwest. We have it just kind of happened, but we do a lot of quantitative research, as you might guess from my prior statements, on the markets. We're looking at job growth, unemployment trends. What was the unemployment going into COVID? How did it respond coming out? Industry diversification, all those different things. But we initially were investing in Dallas, our office in Dallas, but things just got too rich for us. And so we
Hmm.
sold out. Then we went into West Texas for a while and found that some of those markets were just too small for us. And so we then started investing in Oklahoma City a number of years ago, and we have a large presence in Oklahoma City. And another one of our top 10 markets, based on the quantitative research we had, was Tulsa. And so COVID was underway, and it just made sense to have our next step be Tulsa, since it was one of our top 10 markets anyway, because of our presence only an hour and a half away in OKC. Now, what I don't do, I don't speak publicly a lot, but when I do, people ask me a lot, where markets are you focusing on now? And I don't really like to announce to my competitors where I'm finding really good deals. And so maybe next time I'm on, we'll talk about new markets that we're
Sure.
added. But there are a couple other markets that we really honed in on and trying to get a foothold
Yeah, makes a lot of sense. So, if you can describe for us how your business is structured. Do you have any other partners in the business? Do you have any other key personnel? Maybe just give us some high level overview of how the business is structured today.
Yeah, having run other businesses, one thing I love about the real estate business is that it is a highly leveraged business, and I don't mean debt. I just mean you can handle a ton of production and volume and revenue with a small team. And so, we're a real estate private equity firm. We have several critical resources. I'm the partner in it. I'm the sole partner currently, but we make sure that everybody's interests are aligned by doing tying them to the same kinds of profit, NOI that I would be focused on. And so they
Mm,
participate in the deals. They have salaries plus participate in the deals. And so that way we're all incented to make the right decisions for our partners that we have, the LPs that we have in the deals. But we have a couple super highly quantitative individuals. One guy is a CFA MBA and just
mm,
really bright. Does some of the modeling for us when we are looking at lots of deals, and I can't handle all the reviews. We have another individual that came to us from a trust company. And he's just a great project manager and investor relations. He's very patient with a lot of partners that sometimes I'm not, and so, but he just, he's really grown into the role and done great. And then we also have an asset manager that was formerly the regional director of a property management firm that we used. She was leaving the firm, and so we panicked for a day or two, and then we just said, "Geez, we should really just hire her." And that was also an invaluable decision that, just looking back on it, was absolutely the right thing to do. Would have been a really tough year or so if we hadn't made that decision. And so, she lives in the market, and so she's always out on property, looking at things and making sure things are going as planned.
yeah. Thanks for that.
And
We
we use
appreciate.
just one dovetail to that. We do use third party property managers. A lot of people ask us, well, at your scale, why aren't you managing yourself? And some days we do question that ourselves. But for us, we think that still the highest and best use of our time is to find these distress situations that we really hone in on and turn them around. And so, if we could create 50 or 100% for LPs in a year or 2 years, that's much more valuable than us looking at the portfolio and running this whole business and getting down in the weeds and adding 1% to all of our deals. And so that's the decision we've made at this point.
Yeah. Just staying focused on your specialty, finding great deals, sourcing capital, and hiring outsourced management. So, what's the biggest challenge that you're facing today in your business that we might all be able to learn from?
Oh, biggest challenge is hard. I would say there are three primary challenges right now. Labor is very difficult at the lower wage level. Not our direct labor, but in the property management companies, the ability to find people that want to work. Unfortunately, I think the government had good intentions, of course, with all the stimulus money and increase, the bonus unemployment and all of that they were pushing out to people, but that went on for probably a lot longer than it needed to. And in fact, there's a market I'm aware of that we wouldn't invest in, but they just took their emergency order down this last week. And
Mm,
here we are, September 2022. So I think the emergency's been over for quite some time now. But
right.
anyway, I think what that did, the unintended consequence of those intentional things that were intended to be good, was it taught a lot of people just not to work. It's easier just to collect the government money for a couple of years when you're not making any less than to go and work. And so hopefully the economy is starting to teach them that they need to work again as those things get pulled back. So that's one of our major issues. I would say the financial markets, right? You've got the Fed's been printing money for a very long time, and inflation has been clear to anybody paying attention that it was out of control for a very long time. I wrote a piece on inflation last year that was pretty contentious at the time, but now people would read and say, well, of course that's true. And so, they should have acted sooner, is my opinion. And because of that, they're behind the eight ball and trying to scramble to catch up. And because of that, they're having very dramatic moves in rates, and it's making the banks retreat both on leverage and just lending in general, whether they're even going to lend or not. And so that makes, even when you find a good deal, it has to be a really rich deal to make sense right now. I think transaction volume's down dramatically because of that. Everybody's scrambling to try to figure out how to fix their capital stack to make deals work still. So
And
that would be another.
yeah, no, I appreciate that. Labor, the financial markets, transaction volume, finding those type of opportunities definitely challenges for most of us in the market today. As it relates to your outlook on an overall strategy moving forward into sort of an unknown market, right? There's just so many variables right now. How are you navigating new deals under really um, criteria that's just unknown moving forward? Uh, what is the best strategy for, let's say, a newer sponsor, maybe someone that's got a few deals under their belt, but hasn't experienced real uncertainty like we have in the markets today? What kind of direction would you give to that person that's trying to navigate really some rough waters at this point?
Yeah, well, um, even a year or 2 years ago, prior to the kind of less stable environment that we're in now, we would see deals from some brand new sponsors, and there'd be a gorgeous property that was already stabilized that they're buying, and that they're going to somehow deliver 20+% return average annual. And you look at it, you're like, there's just no way. The only way that you can get to that kind of number is with some significant cap rate compression assumptions. And I think that that's one thing that's dangerous for new participants in the market, is that they're being pressured to try to find these high returns for new LPs so that they can attract money. But the reality is they probably should just be more cautious about those assumptions. Right now you probably should be assuming that cap rates are going to increase, not decrease, at least 50 basis points, maybe 100. And I doubt that many people are modeling that way. So that's one thing. Other danger is to continue to anticipate, forecast expense line items at maybe a 2% growth rate or something in a normalized CPI world, which CPI is not an accurate reflection of inflation. That's a whole other topic. But so if they have a disconnect between their inflation assumptions on their expense versus on the income or the rents, I think that's can make a deal look great. If you're showing 3, 5, 6% rental growth, but then you're showing 2 on expense, I think that's a danger too. So I think it's going to be better for those newer participants to interest to the market. Just be realistic with the potential partners and say, hey, this is a difficult environment. We're making these assumptions. We think they're conservative, but instead of delivering an 18 average annual return to you, we think pretty solidly we're going to be able to deliver 14 to you. People respect that, and they would much rather invest with someone like that that's being realistic than someone that's hoping that everything's perfect, or maybe assuming a world that doesn't exist currently, and then not delivering, right? And so if you don't deliver on the numbers, LPs don't come back. I mean, I think our LPs and our deals, when we push out a new deal, it usually fully subscribes in a matter of an hour or two. And in that, they don't have time to do a deep dive in the research. It's just we've made money for so many of these people so many times over that they're not going to try to backseat drive and guess. They might do a phone call with us as they already know us, and so it might just be, okay, why this one? What's the quick, what's the elevator pitch on why we're doing this one? You tell them, and they're like, okay, I'm in for $250,000 or $500,000 or whatever, and that's just how it works. And so to gain that kind of trust or that level of commitment from your LPs is just to do what you say you're going to do and deliver. Under promise, over deliver. I think that's the name of the game for a new entrant.
Well, and that brings me to another topic, which is the capital side of things, the equity side of things. Um, it was fairly common to see a lot of sponsors release their deal and then get the follow-up email not too long after that it's fully subscribed or limited room remaining in an opportunity. I have seen more recently more and more sponsors who are really having to put in the effort to get the equity, get all the equity in that they need. Have you had the opportunity to work on a new deal since we've had the Fed rate hikes?
We have not gone all the way to our partners with one yet. We've underwritten quite a number of deals. There's one right now that we're about to submit an LOI on. It's not a large deal. I'm not even sure off the top of my head, but about 150 units.
Mm,
Um, and so, we're not going trying to raise 10, 20 million on it. It'll be 2, 3 million or
hmm
something like that. And so I
hmm
still anticipate that that'll fill really quickly. I think I would be concerned right now going to market on a large raise, 25, 30 million, some kind of new asset or new build. I just think that that's going to be difficult. And, you really need to raise capital if you're raising capital, excess, because there are going to be surprises most likely at the closing table with the lender. They maybe not be want to deliver the full proceeds, or they may have a rate adjustment or something like that. And so you don't want that to blow up your deal. So you just plan for unknowns. Um,
And would you say
one
that
one thing,
you've been,
just
go
one
ahead,
thing that
Bruce.
we've changed about our capital stack, or in the process of changing, because of my perspective coming from the regular the equity markets, the capital markets. I think something like 75% of the net worth in this country is controlled by people that are 55 and older. I mean, that's kind of
Mm,
intuitive because they've had time to save the money and accumulate and invest over the years. But their number one need is income, and safe income, not a 2%
hmm
yield on the S&P that might fluctuate 30%, right? They want stable income. And the Fed has really taken that away with their policies. And so bank deposits really don't pay much. Even when the rates are higher in bank deposits, they're never going to keep up with inflation. It's just by design. And so one thing we were asked to do by a very large institutional investor was they had an income fund, and they said, "Can you consistently deliver us, 4 or 5%? We're using multifamily." Well, yeah, that's easy. And then they said, "Well, could you do 20 or 30 million a month?" And you're like, wow, okay, so that's tricky. So we spent a lot of time trying to think about how could we do that.
mm,
And what we realized was, listen, we're already paying millions of dollars a year in interest to Freddie Mac or to regional banks and all that. And like, why don't we just create an entity that is the lender as
mm.
well, and send that money to partners, that interest income to partners for the income that they need for the fixed income allocation. So it's a different bucket of money. It's much more conservative, but it's higher in the capital stack for them. They're senior to the LP or
Mm.
equity money that's in it. And it one thing that is beneficial to us is in a period like COVID, when it's time to buy, or a period like now when deals, there are going to be some opportunities to buy in the next 6 to 12 months, if not maybe 24, but certainly no more than that, where sponsors had assumed they would be able to refi at 300 basis points lower than the bridge note they took out, or that there's going to be cap rate compression, and now there's not. And so they're just going to be stuck, and somebody's going to have to take them out of those deals, and we want to be positioned to do that. And the problem with banks these days is they get aggressive when times are good, and they're never conservative until it's already apparent that they should have been conservative for a year or two.
Hmm
And so it was very difficult to get lending on the 4 deals we bought during COVID, but because of our experience and capitalization, we were able to do so. But I mean, those 4 deals alone were life changing, and so for our
hmm
partners and for us, I mean, just incredible returns. And so by controlling an entity for partners that are for their safe fixed income money, I think that will enable us to continue participating in difficult times, whether lenders are lending or not.
And just for some clarity on that capital stack, that piece, what trying to achieve a 4 to 5%, coupon for that type, is that debt or is that equity?
It is debt. It would be investors are pooling their money into an entity that is the lender, and it's
Hmm
actually, I mean, what they'd asked me for was 4 to 5, but what we're paying is 5.5 now. So
Okay.
it's 5.5% to the partners that invest in that, and it's paid out quarterly, and so they have a steady income. They're the highest, senior most in the capital stack, and it's just a safer place to be. Now it's not 5.5% isn't going to compete with their equity
Sure.
type of investments, right? We still have those that could do 20+% or whatever, but it's just a different bucket of money. They're safe money,
And
and so
do you still have more traditional debt on top of that? Or is
no.
that okay?
Well, we still, depending on how much is flowing, because we have to put a governor on the inflows for that. We couldn't just take in $200 million into that fund because those rates are really attractive right now, and then scramble to try to put it out because there would be months that went by that we wouldn't be earning the money to pay back the debt service. And so we have to kind of control the inflows of it to some extent, but we can deploy it really quickly because we're not using a third-party lender, right? If we had to go to Freddie, that's going to be 60 days before we can get that paper put on, and then this other paper would be additive. So, there would be a couple months that went by without earning interest. So instead, it's just this entity that the partners invest in. It pools all, it is they have the diversification of all the assets that entity has funded, and so it's not just they're not just dependent on one asset to pay their interest. They have the power of all of it. Now, are we going to do all of our deals with that entity? Probably not at this point because we're trying. Like I said, it's fairly new and we're scaling into it. But ultimately, at some point, we will.
Makes sense. So, in the time that we have left, I'd like to just get your thoughts on overall economic outlook moving forward. You're a pretty insightful guy. You don't have, at least I don't think you have a crystal ball, but you sold everything that you owned in late 2007 and started buying again in 2010, 2011. That's a pretty darn good track record with a lot of people that really, lost their shirt. So I'm interested in getting your thoughts on economic outlook moving forward and what the next maybe 12 to 18 months might look like for investors.
Okay. Yeah, I mean, economic outlook, there's several different pieces to that. One is there's a lot of discussion going around on whether there's a recession. Well, absolutely that we're in a recession already. I said there was a conference I spoke at, I think it was March or April, that we were absolutely going to be in a recession at that point. It was predictable. But, it's been over 50 years since there was any contention over what the definition of recession was. And there was never any discussion about changing that until the week before the last GDP print came out. And it was really insightful we noticed really rapidly that when all the mainstream media started talking about, two quarters of contraction of GDP doesn't really mean that there's really a recession. When everybody started talking about it the same week, the week before the GDP was going to print, we absolutely knew there's going to be a second negative GDP print. And so, yes, we're in a recession. How deep is it going to be? It depends. I think there are a couple of wild cards out there. Europe is really setting up to potentially be a disastrous year for them, which has economic impact on us. And it's really because we put sanctions on Russia. Russia is squeezing back and turned off everybody's natural gas. And so that affects production and economies as well as just people's lives and ability to stay warm in a very cold winter. And so that's a wild card out there. Here in the States, we see some leading indicators like copper prices or oil prices, and they've just plummeted off of their highs. That tells me that things are rapidly slowing. I put out a piece, it was a post actually on LinkedIn that people can look up, but it was talking about the unemployment numbers. That was one of the things they were using to kind of cover the tracks of continuing to raise into this, because the Fed's in a very difficult position. They have to keep raising right now for credibility reasons. And so they say, but everything's still strong. Well, there are two different employment numbers that are put out. I won't go into deep detail because we don't have the time, but one is based on household surveys of actual people, and one is basically spreadsheet magic. And so they came out with this massive number, 500,000 jobs. And when you dig into it, 82% of that was, quote, adjustments, seasonal adjustments, birth death adjustments of businesses, all these different things. So really it was, 18%, 20% of what they really said it was. And so then if you look at what did the actual people say? Well, if you look at the household survey that's actually done by the same governmental organization, it showed contraction of jobs. So, I mean, which one do you think feels right? Is it that there are tons of new businesses starting right now, which if you Google layoffs, they're just, headline after headline of layoffs. I think the business or the economy is contracting pretty tightly. That said, does that scare me away from investing new in hard assets or in multifamily, which is really probably the point of what people want to know? And absolutely not. We have a voracious appetite still. We're not going to go and pay up for deals, and we're not going to pay what people may have wanted 6 months ago prior to rates and leverage pullbacks. But but we still want hard assets because one thing that is pretty easy bet is that the government is going to continue to print money. Here we are, they're talking about how big of an inflation problem there is, and the current administration decided to waive $10,000 of debt for all these students. Well, we could discuss whether that's morally the right thing to do or not, but it is highly inflationary policy. And so, because it's like printing all that money. And so, ever since 1971, when we went off the gold standard, there's really been nothing to curtail their spending. And so, the government just, gives more and more money away and more pet projects. And so if you look at a graph of it, which we don't have time to do, it's not only increasing the rate of change, or the slope of the curve is accelerating. And so the debt in this country is just absurd. We're already 30 trillion in debt, not including about 100 trillion of off balance sheet stuff that they don't magically count. But so by the end of this year, there'll be 33 trillion because there's about a $3 trillion deficit. 33 trillion and the raising rate's 300 basis points. That's another $1 trillion of debt service. Now, keep in mind, the government's already borrowing money to pay the existing debt service. And for those of us that do a lot of commercial notes, that's IO, that's interest only, that doesn't amortize. And so they're adding $1 trillion to their debt service they were already borrowing to pay. And there's no way to save to that because the U.S. government collects about $3.5 trillion a year. They spend about $6.5 trillion a year, and so it's not coming from savings. And how do they increase rates that much while reducing their debt? Mathematically, it doesn't work. And so I'm betting against the narrative. I'm just looking at the data, and so I want more hard assets because I believe dollars 5 years from now are going to buy less than they do today. And so short term, 6 or 12 months. Model conservatively so you're protected against fluctuations in employment and things like that, because there will be some difficult times. But 5 to 10 years out, I want to own hard assets.
Love it. Well, that's a great way to end the show here, Bruce. Great insights. I appreciate you coming on and sharing your thoughts on the economy and where we're headed, some of the past experience that you've had, and the track record that you've had in the past. Before I let you go, what's the best way for our listeners to learn more about what you have going on in the future?
Yeah, like everybody, we have an online presence. We're not really all over social at all, but elkhornpartners.com. There's a tab there you can click to look at our prior deals, as well as put your name in there so that you're notified of future deals. Or you can always just DM me on LinkedIn if you'd like, and Bruce Fraser's Fraser, and let me know what you're interested in, and we'll make sure the right people get in contact with you.
Great. Well, again, Bruce, thanks for coming on. If for all you listeners, if you've enjoyed our conversation with Bruce, go ahead and go down in the show notes right now. Click on one of those links to connect with him, either through his website or through his LinkedIn profile. Again, Bruce, an honor to have you come on the show. Thanks for sharing your insights, and I look forward to staying in touch with you down the road.
Yeah, thanks, David. I appreciate it.